Now, according to the present value of business in the world of coffee, the present value is $460 billion, the value of coffee business in the world. How much are the coffee exporting countries getting out of that? Only $25 billion. 460 billion, but all the coffee growing countries of the world, all of them, Brazil, Colombia, Vietnam, Uganda, Africa, you get $25 billion. Our wonderful Africa, out of that, gets $2.5 billion. Dead over my dead body. I have banned all the export of unprocessed minerals from here. Let them stay in the ground. When the grandchildren come, they will get them out.
No one in America saw this coming. Overnight, a country thousands of miles away quietly pulled a lever that could ripple through U.S. businesses, coffee markets, and even diplomatic relations. Uganda, one of the world's most important coffee producers, signaled a move so bold it immediately set off alarms in Washington. This isn't just about coffee. It's about power, leverage, and a growing rebellion by producer nations that are tired of exporting wealth while importing poverty. When Uganda drew a line, it exposed how vulnerable America's supply chains really are and how fast the global balance is shifting. Because when the beans stop flowing, the consequences reach far beyond your morning cup. The announcement landed without warning, and within hours it was rippling through trading floors, commodity desks, and diplomatic backchannels across Washington. Uganda, one of the world's most important coffee producers, had just made a move no one in America expected. Coffee, a daily ritual for millions of Americans and a multi-billion-dollar trade artery, was suddenly at the center of a geopolitical shock. For decades, Ugandan coffee beans quietly flowed into U.S. ports, filling roaster warehouses and powering. From New York to California, it was business as usual, predictable, dependable, almost invisible, until it wasn't. One decision from Kampala flipped that assumption on its head, exposing how fragile America's supply chains really are when producer nations decide to rewrite the rules. At first, the headlines sounded unbelievable. Social media lit up with disbelief. Analysts scrambled to verify the reports. Was Uganda really cutting off coffee exports to America? And more importantly, why now? This wasn't just about beans. It wasn't even just about coffee. What unfolded was a classic power play, years in the making, rooted in frustration, leverage, and a growing sense among African producers that the global trade system had never truly worked in their favor. Uganda is not a minor player in the coffee world. It is Africa's second largest coffee exporter and one of the top producers globally. Coffee is the backbone of its economy, supporting millions of farmers and generating critical foreign exchange. For years, Ugandan leaders watched as raw beans left the country at low prices, only to return to global markets as premium products worth many times more. The value wasn't created at home, it was captured elsewhere. So when Uganda's president signaled a hard shift in policy, it sent a clear message. The era of cheap raw exports may be ending. The decision stunned American buyers because it challenged an assumption the U.S. had relied on for decades, that access to agricultural commodities from the global south would always remain open, affordable, and politically neutral. But in today's world, nothing is neutral anymore. Behind the scenes, pressure had been building. Ugandan farmers complained of volatile prices and shrinking margins. Policymakers questioned why the country remained dependent on exporting raw commodities while importing finished goods at premium prices, and globally, a wave of resource nationalism from minerals to grains was gaining momentum. Uganda's coffee move didn't come out of nowhere. It was part of a larger awakening. In Washington, the reaction was swift and uneasy. Coffee might not be oil, but its economic footprint is enormous. The U.S. is one of the world's largest coffee consumers, and disruptions, even short-term ones, can ripple through prices, businesses, and consumer confidence. Roasters hedge futures, retailers adjust contracts, and politicians quietly ask the same question: how did we let ourselves become this exposed? The timing made the shock even sharper. Global supply chains are already strained. Climate pressures are squeezing harvests, shipping costs remain unpredictable, and now a key supplier was signaling that access would no longer be automatic. Suddenly, America's morning cup of coffee became a symbol of something much bigger, a shifting balance of power. Critics were quick to frame Uganda's move as risky or confrontational. Supporters called it long overdue, but both sides agreed on one thing: this decision changed the conversation. No longer was Uganda simply a supplier at the end of a long value chain. It was asserting itself as a decision-maker, willing to use its resources as leverage, and the implications stretch far beyond coffee. If a country like Uganda can challenge the U.S. over agricultural exports, what does that mean for other commodities? Cocoa, tea, minerals, energy. The move hinted at a future where producer nations coordinate, negotiate harder, and demand more value at the source. For consuming nations, it was a wake-up call. What made this moment so powerful wasn't just the policy itself, it was the confidence behind it. Uganda was signaling that it no longer feared backlash the way it once might have. Global dynamics have shifted. New trading partners have emerged. South-South trade is expanding. Options exist where dependence once ruled. As American importers reassessed contracts and analysts recalculated risk models, a deeper realization set in. This wasn't an isolated incident, it was part of a pattern. From Africa to Latin America, resource-rich nations are asking the same question: why should we stay locked into systems that leave us with the smallest share of the reward? And so the coffee ban became more than a headline. It became a warning that the world America grew comfortable with, one where supply was guaranteed and power was assumed, is changing fast. A warning that economic leverage is no longer monopolized by the biggest consumers, and a warning that even the most ordinary parts of daily life can be disrupted when global power shifts. The real question now isn't whether Uganda's decision will hold, it's whether this is just the beginning. Because if coffee, a product woven into America's culture, economy, and identity, can become a bargaining chip, then nothing is truly off limits anymore, and the next shock may already be brewing. What made Uganda's move so unsettling for Washington wasn't just the announcement itself, it was the realization that this decision had been quietly prepared long before the world noticed. This wasn't a spontaneous reaction or a symbolic threat. It was the result of years of internal debate, mounting pressure from farmers, and a growing conviction among Ugandan policymakers that the old rules of global trade were stacked against them. For decades, Uganda played its assigned role in the global coffee system. Farmers grew the beans, middlemen collected them, exporters shipped them out. And the real profits were made thousands of miles away, where roasting, branding, and retail turned a low-priced agricultural product into a luxury experience. A cup of coffee sold for $5 in an American, often traced back to a farmer who earned only a few cents. Inside Uganda, that imbalance became impossible to ignore. Government reports showed the same pattern year after year: rising production costs, climate stress on farms, and price volatility that left growers vulnerable. Meanwhile, global coffee companies posted record earnings. The question Ugandan leaders began asking was simple but dangerous: why should we continue exporting raw value while importing finished wealth? That question marked a turning point. Behind closed doors, officials explored a radical shift, one that would prioritize domestic processing, local value addition, and tighter control over export channels. Instead of rushing beans out of the country, Uganda would slow the flow, redirect supply, and force buyers to negotiate on new terms. The goal wasn't isolation, it was leverage. From Kampala's perspective, America wasn't being targeted out of hostility. It was being targeted because it mattered. The United States represents one of the most lucrative end markets for coffee in the world. Any disruption, even a hint of one, sends signals through futures markets and supply contracts almost instantly. By challenging access to that market, Uganda wasn't just protecting its farmers, it was reminding the world that producer nations still hold the source of the supply. In Washington, the response revealed how deeply that assumption of access had been ingrained. Officials initially downplayed the move. Industry spokespeople called it temporary. But behind the scenes, contingency plans were being drawn up. Importers explored alternative suppliers, roasters recalculated costs, and analysts began whispering a word no one liked to hear: precedent. Because if Uganda could do this, others could follow. Coffee isn't the only commodity where African producers dominate the source while losing the value. Cocoa, tea, cotton, and critical minerals all follow similar patterns. Uganda's action signaled a broader shift, one where resource-rich countries are no longer content with being price takers in markets they fundamentally sustain. What made the moment even more striking was the global backdrop. The world is already fractured by trade disputes, sanctions, and supply chain realignments. Trust in globalization's old guarantees is fading. In that environment, Uganda's coffee decision didn't feel like an outlier, it felt inevitable. And Uganda wasn't alone. Across the global south, governments are watching closely. Some see opportunity, others see risk. But all see a lesson: control over supply still matters, especially when demand is concentrated elsewhere. By asserting that control, Uganda inserted itself into a conversation usually dominated by far larger economies. Critics warned of retaliation. Supporters argued that fear had kept producer nations weak for too long. Uganda appeared ready to test that fear and see what would actually happen if it refused to play by the old script. The deeper message was impossible to miss. This wasn't about punishing America. It was about resetting the balance, and as negotiations, statements, and speculation continued, one thing became clear: the global coffee market would never look the same again. Whether the ban held, softened, or transformed into a new framework, the psychological shift had already occurred. Producer nations had seen their leverage, and once leverage is discovered, it is rarely surrendered. The consequences arrived fast. Contracts were reassessed, risk premiums rose, traders adjusted positions. Even the hint of restricted supply was enough to push prices and inject volatility into a market built on predictability. For American roasters, the reality was stark: higher costs, altered blends, or supply shortages. None are easy, all hurt margins, and all eventually reach the consumer. Diplomatically, pressure mounted quietly. No public standoff but urgent conversations behind closed doors. Uganda had forced itself into the center of global trade discussions, punching far above its weight. Inside Africa, the signal was unmistakable. Producer nations were watching, studying the response, measuring the cost, and the courage of defiance. For Ugandan farmers, the stakes were immediate. If this move delivers better prices and local value, it becomes a model. If it fails, the backlash will be fierce. Either way, the old system is already damaged, because the illusion has collapsed. The idea that producer nations must accept whatever terms are offered no longer holds. Uganda proved that control over supply still equals power. This was never just about coffee. It was about who controls value in the global economy and who has been giving it away. Uganda's decision delivered a warning that reached far beyond Washington. The era of guaranteed access is ending. Producer nations are asserting themselves. Supply chains are becoming bargaining chips, and everyday commodities are turning into instruments of leverage. So the next time you drink a cup of coffee, understand what's really in it. Not just beans, but a signal that the balance of power is shifting and the next disruption could come from anywhere. This one started in Uganda, and it won't be the last.